Good morning. Welcome to the B.F. Anderson Technical Report for December the 8th. Ned Johnson III. He was the son of the founder of Fidelity, which we know as a big financial brokerage firm, mutual fund company. When they first started the company, it was a family business, just like my company. I mean, very small. But the importance of Ned Johnson is that he has been a mentor to Peter Lynch, who went to work for Ned Johnson back in 1972. And Ned Johnson mentored him, and then he took over the Fidelity Magellan Fund in 1977. So what was interesting about his mentorship, and I have to say, in the early years of a portfolio manager's career, having mentors is incredibly important. I have had probably about 3 mentors early in my career that really helped me understand what I needed to know. Now, Peter Lynch went to work in 77 with the Fidelity Magellan Fund, and call it luck, call it whatever you want, but he caught one of the greatest bull markets of all time. You see, in order to make money in the stock market, you've got to have an uptrending market. So when Peter Lynch started managing Fidelity Magellan, one of his largest positions was Walmart. So Ned Johnson taught him many things, of which was primarily to invest in growth stocks, understand growth stocks, and he also taught things such as being patient. Patience is very important. He said the stock market is a patience game. But one other thing that Ned Johnson talked about, they asked him one time if he was on a desert island and could only have one indicator, what would it be? And he said it would be the 200-day moving average. So that tells me right there that Ned Johnson was a trend follower. We're trend followers. So as you can see here, this is the S&P where we are now. This is as of yesterday. Basically what it's showing here, I'm sorry, this is not currently. This is the bottom of the market in 2009. So in other words, I'm showing you a historic example here of the 200-day moving average, just to kind of set the stage here a little bit. So as you can see here in 2008, now this is going into the financial crisis. We were below the 200-day moving average, and then the S&P in June, July of 2009, the market had made a low, and then we broke out above the 200-day moving average, and then the 200-day moving average turned up. Now, what was critical, and what's critical right now is at the same time the NASDAQ broke above the 200-day moving average and went into an uptrend as well. But also notice the type of decline we had here. This was quite dramatic. Now, if we look at the low in 2002, which was after the 2003, after the dot-com bust, same scenario. You know, the S&P was underneath the 200-day moving average, and then around March the 10th of 2003, we started to move up. We had made a low, and we broke out above the 200-day moving average. You can also see here with the NASDAQ around the same time, the NASDAQ broke out as well. So you have to have that confirmation of not only the S&P breaking above the 200-day, but the NASDAQ. And also it's important to understand that the moving average needs to be turning up. Now, if we look at where we are today, you can see here that we have had what we call bear market rallies, where the market is in a downtrend. There's no doubt about it. And we got above the 200-day, but then it failed. And then back here in the summer, we got close to the 200-day, failed. And it looks like we're failing again. You know, so these are what we call bear market rallies. We are in a bear market. And you can also note, and this is really the big problem here, is the fact that the NASDAQ is not cooperating. The NASDAQ is not even getting above the 200-day. And you can also see that the 200-day, both for the S&P and the NASDAQ, are still in downtrends. So patience is key here. If we can get confirmation of the NASDAQ moving above the 200-day along with the S&P, the moving averages turn up, I do believe that's going to be an indication of a market bottom. Now, one of our indicators that I've been really paying a lot of attention to is called the aggression index. And this was developed by my friends in Cabot Research up in Boston. But anyway, what this is a ratio of the NASDAQ compared to consumer staples. We've talked about this many times before, but you can see it made a new low this week. And you can see here that the moving average is definitely in a downtrend and so forth. So the reality here is that until the NASDAQ can get into gear, meaning the growth stocks, it's going to be difficult for this market to get going. Now, another indicator that we are keeping a close eye on is the number of new lows on the New York Stock Exchange. Now, you can see here all during the downtrend of the market, we had real high numbers of new lows. Now, we're starting to see a pickup again back above 40. We want to see, for an extended period of time, the number of new lows get below 40. Now, let's just kind of look at where our indicators. So in other words, what I'm saying is the 200-day, the aggression index, these are, and the new lows, these would be what we would call primary indicators. These are indicators that we pay a lot of attention to. Now, we also pay a lot of attention to this indicator. This is the tides. We call it the tides. Tides come in, tides go out. Well, the NASDAQ, as you can see here, has really been somewhat struggling and really cannot get above the 200-day. This is the 200-day. Now, if you look at and you need to look at 5 indexes. You know, everybody watches the Dow Jones Industrial Average, but you got to realize that's just 30 industrial stocks. And so we look at 5 indexes. This is the mid caps. You can see the mid caps really broke out and moved up above the 200-day, but is now struggling with it. The New York Stock Exchange, this is all the stocks in the New York Stock Exchange. We got a nice rally here. Kind of looks like it's starting to fail. Here we have the small cap stocks. Again, a nice rally, however, breaking down above that, below that 200-day moving average. This is the S&P 500, same scenario. I would say that it's important that the S&P hold 3,900. We were hoping we were going to break out of the 200-day and get above 4,100. Now, the volatility index, we're seeing volatility improve during this rally, but usually when you get to really low readings like this, anything under 21, the rally may be over, and it's kind of like we're seeing the volatility coming back in again. Now, on our 3 economic indicators, I find it very interesting how interest rates are continuing to drop. So what is the market potentially telling us here? Well, here's the price of oil. Here's the financial stocks. Here's interest rates. So is inflation the big problem here, or are we more worried about economic slowdown? I think that scenario is shifting more towards where people or investors are being concerned about an economic slowdown. Now, the bond market, because interest rates are coming down, you can see here on the junk bonds, we actually got above the 200-day and seeing improvement. But where you're really seeing the improvement is in the 20-year Treasury note. So the 20-year Treasury note is really starting to rally here, and people are making money in the bond market right now because interest rates are dropping. But why are they dropping? That's the real question. Now, I did want to make note of a few things. Here's the Golden Dragon ETF. This is China. These are all the stocks that are trading in the United States that are based in China. You can see where the Chinese stocks are starting to kind of pick up some steam here. Now, back to the NASDAQ for a second. This is the semiconductor ETF called the SMH, or the VanEck Vectors Semiconductor. If we can get this particular ETF going, if the semiconductors can get going and the software stocks can get going, that could be what gets the NASDAQ going. Now, we can't ignore the yield curve any longer. I mean, it's just really giving a very deep reading, which is telling us that the market is discounting an economic slowdown. Now, how severe will it be? Well, we keep hearing about a soft landing. Well, hopefully that's the case, but I have not seen in history where that has been the case. Most of the times we really just don't, we do get a recession. Now, these are the top 5. This is Prothena, which is a biotech. Biotechs have been strong. You can see the gap up here. A lot of consolidation moving sideways. I would continue to watch this stock. Impinj, this company's involved in what they call RAIN RFID, which is a new technology, a robust technology. Gap up, consolidation, I would continue to watch. Pinduoduo, this is a Chinese retailer. You can see what I'm talking about on these Chinese stocks. They've really all of a sudden gotten ahead of steam here. This is Nutanix, which is a software company. Gap up, consolidation, breaking out of the base. Keep an eye on it. It looks pretty good. In-phase energy, this is solar. Again, you got your gap up here, you've got consolidation, you got a breakout. However, that was basically a gap up buy signal here that has since pretty much failed because it broke the lower end of that gap up. So all in all, what I'm saying is that continue to exercise caution here. The market is still in a downtrend. We did get a recent rally that looks like it's running out of steam, but if you have any questions, please let me know.